Not every dollar is meant to just be invested for the maximum return. This idea of retirement, this concept, I think it should be pushed back 20 years based on life expectancy.
We know that the market's going to average 7.5%, 8%, but it's the order of those returns that are really going to make and break retirement plans.
If you're still in the military, hanging on till that 20-year mark. All right, hey everybody, welcome back to Remnant Finance. I got a guest in the house today. He was on a couple weeks ago talking about long-term care with Brian, as we announced maybe 2 weeks ago. Going to be deploying here and probably out of the picture for a little bit as far as taking client calls, being on the podcast. We're hoping that when he gets over to the Middle East, he's going to be in a situation where he can record down the line. But in the meantime, it's going to be solo episodes for me and also bringing on some guys like Travis here. We talked about long-term care recently. For those who haven't listened to it, Travis was a Romeo pilot, the same as myself back. We both got out now, both doing insurance. He focuses on life insurance for advisors effectively. So if you have a financial advisor who's giving you a life insurance policy, Travis's team is kind of behind them crafting policies for those who are not experts in life insurance, but offer it to their clients. He also does a lot of annuities and a lot of long-term care. Today, we're going to be focusing on annuities. So, Travis, what's new? You got a lot going on in your life right now.
Yeah, great to be back on. Thanks for having me, Hans. And got a baby on the way. Just bought a new house and did a big move. So a lot of moving parts, but happy to be back on the podcast. And like you said, typically I look to, make relationships with folks who are in the money management space, but we do a lot of direct to consumer too. So for folks listening to this, if you have an annuity, if you have long-term care, the biggest thing is to ensure you get a professional audit on those existing policies from time to time. And, happy to be a resource to, Remnant Finance and, your clients as well. If they kind of are folks who are jumping into, these sorts of strategies that are, gaining popularity here.
Yeah, for sure. We have a revamped website. I just did a full facelift on that, went over every page and totally changed it. And if you go to our services page, we talk about what we do, our framework and how we approach the IBC conversation, how we use the whole life asset. But then we've got our network of trusted partners, and Travis is one of them specifically for annuities and long-term care. If you have an existing annuity, you should be getting on Travis's calendar, and you can book with him on our website through that services page. If you want to explore long-term care, same thing. Go back 3 or 4 weeks for our long-term, maybe 4 weeks at this point, for our long-term care discussion. But today we're going to focus on annuities. We're going to talk, first of all, about the marketing around annuities, why there's an attack on them, like why people instantly have this negative perception. It's kind of similar. It's the same people that give people a bad taste of whole life. Not from having done the research and learned the product and understand its use case, but just from a marketing campaign, just from commercials. We're going to talk about what an annuity is, how we think through it kind of on a big picture, and then we want to get into more specifics, different types. And then finally, we'll talk about at different ages, different types of people when you might want to consider or not consider it. And then also I want to talk through what you guys do specifically and how you do an annuity audit, what that means. But before we talk about auditing an annuity, if people don't know what it is or don't have a good grasp on the product itself or this large family of products with different flavors and different features, let's talk through at a base level what is an annuity.
Yeah. So, base level, an annuity is a financial product that's distributed by life insurance companies, and think of it as the inverse of a life insurance policy. Okay. A life insurance policy, you pay small premiums, and at the end, you get a large death benefit. Well, an annuity is where you take a portion of your existing capital, you give it to a life insurance company, and they pay you a small portion guaranteed for life. And they basically give you return of principal, return of interest, and what are called mortality credits, where basically when you lump in, thousands of people, the insurance company doesn't know exactly when one individual will pass away, but via the large of law numbers, they have a very accurate forecast of what the average life expectancy will be. And when they group a giant pool of assets like that, they make a very small margin, but they're able to forward capital to people while they're still alive based off of knowing that some of those people, won't be around past, certain milestones of life expectancy. So typically annuities, with the principal, interest, and mortality credits, they're able to pay out a little bit more, or some cases a lot more, than people who just, are getting pure just return of principal and interest.
Right. So why is it a
Um,
life insurance company? Like, why can't you just go to, uh, whatever, like Vanguard to get an annuity? Or maybe, I mean, maybe they do have a life insurance department that I don't know about, but like, what is the tie-in with a life insurance, and why is that who offers annuities?
um, just
You kind of
because
alluded
they
to
are
it, but
they are the experts, and like you said, I think you said something really that I liked really a lot on our first podcast. But life insurance companies are the experts and experts around the science of longevity and if what did you say last time?
yeah,
It's the
they're
science of
experts at the science
longevity.
of death, the science of mortality, and
Yeah,
yeah, I mean,
mortality and
longevity, yeah,
longevity. So
yeah.
basically,
So
they offer these products, and I'm sure you could, there's companies like Fidelity, Vanguard that probably have their internal insurance teams, but when it comes to life insurance products, the major players are next time you watch a basketball game or March Madness, you see like every second, third commercial is for a life insurance company, and so they are the major players and are the ones who offer the kind of the flagship models of these products.
so let's just make like a fifth grade example here. You've got some money, you want to set in place a stream of income. You have, let's just say, $250,000. You're like, hey, I saved this up. I could invest it. Every dollar has a different role within your financial strategy, right? Not every dollar is
Right.
meant to just be invested for the maximum return, right? That's why we have, say, long-term care. That's why I have a house. That's why, like we have different assets, right? You say, hey, I want to take this and I want to turn this into cash flow for me and do it for the rest of my life. So rather than going to an insurer, and here's why we need to do this through an insurer, but you just come to me. You come to me and say, hey, if I give you this $250,000, I want you to, starting when I turn 50, I want you to pay me an amount every month for the rest of my life. Well, what information do I need as the one who's going to be paying this out? What information do I need to know how much to actually pay you? I have to make a lot of assumptions, right? What are some of those assumptions? If you and me were just going to have this private annuity between us, I need to know, or I need to have a pretty good idea of a couple of pieces of information, right? And so, what are those factors that go into it?
Yeah, life expectancy first off.
Yeah, yeah,
The actuarially, like how much can you pay someone based off of life expectancy? Obviously, you're going to have some people that live, one, two, three standard deviations beyond life expectancy. You're going to have people who pass away early. So you need a lot of people to kind of sign up and be part of that asset pooling. And you need to know a lot about the science of mortality and longevity there.
exactly. So you give me $250,000, I'm going to invest it and grow it until it's time to start paying you out. And let's just take very easy numbers here, just for the sake of kind of conceptualizing this. I'm going to pay you $1,000 a month. That's the plan,
Okay.
right? So starting at age 50, I'm going to pay you $1,000 a month. That 250,000, if I can't grow it at all, that's 250 payments, right? Again, that's just easy math. I'm just trying to keep it really simple here. If you live for 3 months and then die, I keep the 250,000. I've paid you 3,000, right? But I keep that, right? So that's part of the risk on your end. But 250,000 divided by like a 250,000, 250 payments of $1,000 would last just over almost 21 years, right? So when you turn 71, I've exhausted that money if I haven't been able to grow it. right? So that takes you from age 50 in this example to age 70 there. I've run out of money. And so if you live another 20 years, contractually, I'm on the hook for $1,000 a month for until you die, right? And so
Yep.
just like with life insurance on the inverse, I need to know, I need to have an idea of how long you're going to live, like you said. I need to make some assumptions about what the money's going to do that I invest. Because right now, you're what, 37?
Yep.
30, yeah, 37. So I have 13 years before I have to start paying you. So I can make some good headway. I can get a head start here before I start paying you $1,000 a month starting at age 50. And I don't know if this is like, I'm just making like all of this up, right? But if I'm doing this as the person that's writing and signing my name to a legal contract, and you live to 100, I'm still on the hook. So I could go in the hole here if I don't invest that money properly, if the assumptions I make about the market returns don't play out. And if you live past 71 years, which is, that's the number where the 250 would be exhausted. Of course, I've grown it since then, and I've been growing it over those whole time as I'm paying you. But like, those are the assumptions I have to make, right? So there's risk, and that's why, as you said, we pool all of these applicants together. They make a conservative estimate on market returns so that they're not over promising, and they also make assumptions using their science. And all tying back to the initial question of why insurance companies is because they are the experts in how long people live on average. And so if you pay into this and then you die early, that's a cost to you. Now, of course, there's all kinds of riders and flavors that can bring the scales back a little bit in your favor in that instance. But if you live a long, long, long life, the company's on the hook to pay you for the rest of your life. And so that's effectively what an annuity is. We're setting up a cash flow by providing upfront capital, unlike life insurance, where you pay a smaller premium relative to the death benefit. If you die early in a life insurance policy, the quote return you get is much higher, right? And it's kind of the inverse. So that is that kind of a basic overview. Would you add anything else to my hypothetical example here of what the company's thinking about, what risk they're incurring, what risk you're incurring as we discuss an annuity?
Yeah, I mean, I think, you have a pool of assets, folks who are approaching retirement or at retirement, especially when, they're relying on that pool of assets to provide income in retirement and last their whole life, you know, um, most folks want to thread the needle where obviously they don't want to run out of money, but they don't want to live a very subdued lifestyle and, you know, and lead in a lot of cases, they want to go out and enjoy retirement and not worry about money financially and not spend too little as well. So I think for folks who are trying to maximize guaranteed retirement income and avoid the headaches that and sleepless nights that come with tariffs and wars and market volatility and ups and downs and turmoil there. Annuities offer a method of providing fully guaranteed lifetime income as long as they live, and it takes
Yep.
some of the risk off the table. And I think you touched on a lot of kind of bad marketing out there. Any you listen to any annuity person, and if they tell you like put all your assets in the annuity basket, you're probably wrong. And then on the managed money part of the side coin, right? Money leaving an asset manager's AUM or money under management and going into annuity is dollars that they're not able to charge their 1% fee on. So obviously a lot of these
Right.
guys don't want their clients to purchase annuities either. You have to kind of go through the look at their incentive structure. So a lot of those folks will never suggest an annuity for their clients either. And I don't think that's the right answer. I think the right answer is for someone who wants some of the benefits of annuities, specifically fully guaranteed lifetime income, taking a sliver
Mm-hmm.
of their assets and solving for kind of that baseline really, one, allows them to a lot more peace of mind throughout those retirement years, and two, lets them invest and maybe take some shots with their existing money that's in the market versus having to be in a really conservative bond, extremely bond heavy portfolio. Because kind of rule that you probably hear in the financial services industry thrown around a lot is the 4% safe withdrawal rule.
Yep.
And that basically states, hey, in retirement, the maximum amount of your assets you can draw in any particular year is 4%, and that allows ups and downs, and is basically the safe withdrawal amount that ensures you'll never run out of money. Well, in the annuity marketplace, you're giving up some of that liquidity and access to those funds, but for a person who might be looking at a 4% withdrawal rate, depending on their age, you could get 6.5, 7.5% with withdrawal of your money in the form of fully guaranteed annualized income with that same amount of asset, the same dollar amount of assets.
Yeah, I think that anybody who listens to us knows that we hammer pretty hard that mindset of, like the 4% withdrawal, just conceptually, the idea that we're going to rely on our time where we need certainty, i.e., when we're not working and generating income. It's like I can take risks right now if I'm working and have income. I can take market risks because if those go down, income still comes in. But if I'm in the phase of life where income and everything that comes in is determined by what I currently have in place, which again, it's not a concept that I really like, this idea of retirement, this concept. I think it should be pushed back 20 years based on life expectancies. Back when they had Social Security at 65, the life expectancy was like 67, 68. So this is your final little couple years that you're getting this income. Now, people are living much longer than that. The idea that we're still retiring at 65 to me just doesn't resonate. But if that's what we're going to go with, if we're going to grant that premise that at 65 we stop working and now we're living off of what we currently have in place, it's like the game board's set. Now we have what we have, that pile of money. I just don't like this idea that something has to go right and multiple things have to go right. The taxation doesn't change. The market performs. I don't enter retirement in 2008 at a time when I could never recover even at a 4% safe withdrawal rate, right? I think that now we're going to come on that safe withdrawal rate concept came from the Trinity study where they said, if we take all these snippets of the market, each of these 30-year snippets, you wouldn't have run out of money over a 30-year retirement window. Doesn't mean at 31 you wouldn't, right? But one of my Brock Fortner is a financial strategist who I really like to read the stuff he puts out, and he in one of his recent newsletters he talked about if we took this 30-year snippet of the market, this withdrawal rate would have worked. You would have not run out of money for 30 years.
Yeah.
However, if we take that same 30 snippets, those 30 years returns, and run them backwards, right? So you start in year 30 and you work backwards to 1, because all it is just a string of numbers. They take a string of numbers and they say, market goes up, market goes down, but here's the average rate of return over this 30-year period. Had you taken 4%, you would not have withdrawn all of the capital out of this. You'd have money. You'd be in positive territory, even if by a dollar at the end of 30 years. You didn't drain this account. But if you take those same 30 data points and reverse the order, so you retired in year 30 and worked backwards, and those were the returns you got, you ran out of money in year 13. So it's a kind of, to me, a pointless study, and it's not what I'm going to hinge my retirement on, this idea that if the market cooperates. And that's the point in life where I want the guarantees. That's where I want the certainty and the cash flow that I can't outlive. Because if the Trinity study that came up with that safe withdrawal rate was based on 30 years, and people are now living on average 40 years past retirement of 65 or 30, I don't, there's places in my life where I want risks and maybes and what if and hopefullys. When I'm talking about protection, when I'm talking about savings, and when I'm talking about my non-income generating years, if I'm going with that standard retirement, that's exactly where I don't want any uncertainty or reliance on the market of all things.
Exactly. And I think you hit the nail on the head there. We know that the market's going to average 7.5%, 8%, but it's the order of those returns that are really going to make and break retirement plans, especially in those early years. It's called sequence of return risk. Google SOR, sequence of return risk. And, basically, if you draw down and the market goes down in, those first few years of retirement, like you said, folks risk running out of money. And, I would suggest folks talking to your asset managers, money managers, talk about sequence of return risk. And again, no one's saying, if you talk to an insurance or an annuity broker who tells you to put all your money in an annuity, run away from that guy. But, I think there is an argument to be said, and I think the data supports this with record-breaking, years of premium spent on annuities over the past, 3 or 4 years, every year has been a new record. But I think there's something to be said about kind of solving for a guaranteed income floor and taking some of that risk off the table, leaving some in the managed money, in your asset managers, uh, under their management. But I don't think having all your eggs in one basket is a smart plan, and especially like you said, at a period of time where we kind of want some certainty. We don't want sleepless nights. A guaranteed income stream that is going to be there month in and month out, so long as you're alive and fogging a mirror, is something that a lot of folks find really appealing.
Yeah, absolutely. And we, right now, Remnant Finance, we're as busy as we've ever been, which is really frustrating that Brian is being deployed at this point in time, because that just not not ideal timing with the business. But most things aren't ideal timing. So my calendar is not full of people saying, "Hey, how do I get the most dollars out of every dollar that I have?" I'm not having conversations with clients who want to know what is the best rate of return I can get. Though that is the typical challenge that people have initially, is, well, why would I put my money here when I could make more money in the market? And so, yeah, you could maybe make more money in the market. You probably would make more money in the market. I can say that almost certainly over a long enough time frame, you're going to make more money in the market than you will with your cash value growth in a life insurance policy. The reason you're on my calendar, the reason we're as busy as we've ever been, is not because every dollar's role is to just be maximized. We talked last week with Joe Withrow about the quality versus the quantity of your dollars. Some assets, your goal is to maximize the quantity, and that is like your retirement account, right? Because you need quantity to overcome the other drag factors, like the fact that you're locking this money up for decades and can't touch it, the fact that it's earning money on for someone else right now while they're controlling it, and in a few decades you get a drip of it that you can take some of it back, right? In order to overcome that drag, you need high quantity. But a lot of other dollars, you want high quality. You want them to, on the scorecard of asset characteristics, liquidities, guarantees, safety, growth, tax favorability. It said all these things that we would grade if you give a report card to every asset on how they match up in these attributes. When we're having this conversation, we're talking about high quality capital, not high quantity capital. And I would put annuities in the same bucket, where we're talking about high quality capital that's not dependent on the market. Who listening right now feels confident about the next 12 months being great for the U.S. economy? I don't think anybody does, right?
Yeah. Well, and
If I
like,
have an annuity, go ahead.
yeah, I was going to say, to piggyback off that, the payout rates on these annuities are structured on prevailing interest rates. So right now, with the kind of interest rates still being near kind of recent all-time highs, the payouts are extremely competitive, and in most
Right.
cases are going to beat the brakes off of the 4% withdrawal rule. So and that's one of the reasons why we're seeing record breaking numbers in the annuity marketplace over the last few years. But if you zoomed back to 2020, right, when interest rates were scraping the bottom of the barrel, some of the lowest we've ever seen, annuities weren't very popular, just because at that point, the payouts on them were less than the 4% rule, because they're all built and structured off of prevailing interest rates at the time of purchase. So right now, while interest rates are high and the guaranteed payouts on them are the highest we've ever seen, that's why we're seeing such action in the marketplace right now. It's just because there's nowhere else you can take a withdrawal that is fully guaranteed, and in some instances double the 4% with safe withdrawal rate.
Yeah. And that speaks to the value of having this comprehensive strategy beyond just trying to maximize the quantity of every asset's dollar value. Like right now, if you had to put your next paycheck on, will 2026 will the market be lower or higher than it is right now? I feel like a lot of people, probably more people than not, would say, I would, if I had to bet money, gun to my head, we're going to be in a worse situation at the end of 2026 than we are right now. We're going through a lot. There's a lot of uncertainties right now. Of course, if this Straits of Hormuz issue lasts for another few weeks, like countries around the world, we're insulated from a lot of this damage that we're causing on the oil market, et cetera, because we have such deep reserves. But a lot of countries, like the Philippines, are declaring oil emergencies or fuel emergencies, right? If that continues and we get this kind of cyclical compounding effect of negative economic news, and people have to start selling other assets that might otherwise be totally fine, just like we talked about with Joe with the private credit last week, your private credit fund might be strong as ever. But if another private credit fund is putting up the gate and not allowing withdrawals, as is happening right now, and people need capital, you take the money you can get, not the money you would like to pull out. If you can't pull out from your Blue Owl fund, you might go to your BlackRock fund, right? And so we're getting these draws out. So all these factors, there's a lot of uncertainty right now, and I don't feel confident that if I was starting retirement this year and knowing that the early years of my of this sequence of return are very important to the long-term growth, the more uncertainty, the more risk and loss I take now, that those losses have a longer time to compound. Well, I don't feel very good about taking money out of this market right now. I just don't, honestly. I don't know. I have a lot of uncertainty, right? And if you feel uncertainty, that's a great indicator that having a certainty asset, i.e. an annuity in this case, is very powerful, because it's really nice to know that if I'm watching my stock portfolio plunge, and again, long term, it's going to come back up most likely. I feel pretty confident that it will. But in this year, if I don't want to be taking money in a down market, it's pretty nice to know that I have a 7, 6, 7, 8% guaranteed annuity stream coming in every month, regardless of what the market does. We always talk about uncorrelated assets. Our life insurance cash value growth is not correlated to market performance. It's a contractual guarantee. This is the same thing. On our protect, save, grow framework, I would put an annuity on the protect and save side just because it is a cash flow. It's a guarantee. We're not just trying to spin it up for as much possible return as we can possibly get. Like, we want longevity here, and I want something I can't outlive, and I want something that's not correlated when I'm talking about the safety component of my strategy.
Yeah. So I think you hit the nail on the head. Let's I guess get into kind of the various species of annuities if you're
Yeah.
ready to kind of move there.
Well, I want to make one more point that
Yeah.
the first time we met, mutual friend put us in contact because we both flew the same aircraft as him. We both are in the life insurance space. We got lunch. This is what, 2 years ago now, maybe.
Something
But
like
you
that,
said
yeah.
something to me because we were talking about the VA disability claim process. And we're talking about if you were to get 100% VA disability with the family, it's something like 4,000, 4,200. I think at the time I was going through the process of filing my claim. And you made this point that really stood out to me because at the time, even though I had rethunk all of my thinking on everything, annuities just hadn't crossed my radar. I've learned that everything I thought about whole life insurance from Dave Ramsey and from financial advisors has been totally wrong, totally off base, because they either don't understand it or they intentionally misrepresent it. It's one of those two. It can't be a third option where they know about it and like they either don't understand it or they misrepresent it because they were flat out wrong. I've had that reckoning with a lot of my prior assumptions in medical, military, financial, right? The whole last 5 years has been very eye opening for me. But annuities just never crossed my desk. I never thought about them, right? Because I don't have one. I never wanted one prior to learning about this way of thinking about capital. I just never thought about it. But when you described to me and you said, think about what you would have to put into an annuity if you were to make a single payment annuity, and I'm 35, 36 at the time, so maybe a year, maybe 2 years ago. In order to guarantee that stream of tax-free income, i.e. whatever $4,200 that you would get if you were to get 100% VA disability, you'd have, I think you ran the numbers, but you're like, I think you were looking at it for yourself at the time, like filing your claim or whatever. Do you remember? I don't know if you do you remember the number you told me that I would have to come up with
Yeah,
to
I
put
think
down as a chunk of capital to generate a $4,000 a month tax-free income stream?
I
This blew
think
my mind. Do you remember
it
this?
was something. Yeah, I do. I think you were looking at it, and we were also kind of, like you said, talking about annuities, and I was like, I broke out my laptop like a nerd at lunch, and I ran the numbers on a 36-year-old, I think, and I want to say it was north of like $2.5 million.
That's the number I remember. 2.5. That stuck with me. So just to go back to our example, the fifth grader example, if I were to today, well, we'll say I'm 37 now, we'll say I'm still 36, but we're having that same conversation, and I wanted to say to you, hey, Travis, starting next month, starting April, for the rest of my life, I want you to pay me 4 grand a month, tax free. I mean, you don't have to control the taxes, obviously, but if we're thinking about taxes, what if this is a taxable event? We'd have to come up with more than four. You'd have to pay me more than four if I'm going to get tax free after taxes. I'm going to get 4K, right? So maybe that
Yep.
number is 30% higher, 20% higher, something like that. So hey, I need 4,800 a month to have a 4K post tax profit or net, right? And I want you to do that for the rest of my life, even if I live to be 110. Every single month for the rest of my life, you need to pay me 4,800 so that I have four after the taxes are paid. I would need to come up with $2.5 million to give to you today that you would grow and every single month peel off that chunk, pay me that check every month. When I thought about it that way, that's when I realized, okay, I need to get on your calendar to learn more about annuities because this is not something I had really thought about before. Because I could I could save up the money to generate like to buy a printer effectively. That's like kind of how I think of it. It's like this little black box printer. How much if I dial in and if I think whether it's a stack of $30,000 cash, I'm going to go buy a car. I could dial in the interest rate that I'm going to get on that money. If I know I could make 3% on that money guaranteed for the rest of my life, I dial that in at 3%. If I go buy the car at the dealership and hand them a stack of 30 grand, I've given up the money that thing could ever print for me ever again. Well, in this case, to get that kind of returns, I would have to have a printer worth $2.5 million. That's wild to think about. And so, without coming up with the $2.5 million, and this is just for any military folks listening, don't sleep on your VA return because if you get 100%, you don't have to come up with the 2.5 million today. You just get that paid to you for the rest of your life. You've already quote done it through the service, right? You don't have to come up with 2.5 million in order to generate that check. So that was just that was the first time that I thought, okay, here chalk us up to another instance of I was misled by marketing, I was misled by financials checkers grandmaster Dave Ramsey, like all of these things that I just assumed. I heard annuity, I was like, oh, scam, forget about it, no point. But when you made that point that your VA claim is an annuity that you don't have to come up with the capital for and it just generates guaranteed tax-free income for life, tax-free in the case of the VA claim, not necessarily all annuities, but that
Yeah.
was
No.
so mind-blowing to me.
And I think like there's a lot of talking heads out there that trash annuities, and I think in some cases, rightly so. I think there are good annuity constructs out there and bad annuity constructs out there, and
Yep.
people selling them for the right reasons and people selling them for the wrong reasons. That being said, a lot of the talking heads who trash annuities look at their incentive structure. They're money managers. They charge their 1% fee on managed funds. So any dollar that leaves their advisory, they are not able to charge their fee on it. So it's not putting food on their table. Of course, they're going to hate any sort of, if you say, hey, I want to buy a rental property, I want to buy, an annuity, they're probably going to try and talk you out of that, or at least
Yep.
not all of them. There's some really great guys out there, I'm sure, but in any, sphere, there's going to be people who, act in their own self-interest before acting in clients, giving advice to clients that's, not partial. So, look at the incentive structure. But that being said, like there are a lot of really poorly designed products and companies and
Oh yeah.
stuff people get into that they don't know what they're purchasing, and so there is some merit to it for sure.
Yeah. So all right. So you steer from here. Just give us kind of an overview. Like, what are the different flavors? What are the riders? What are let's just talk
Yeah.
through what to be thinking
Okay.
about when you're looking at this.
So, I mean, basically, the main reasons to purchase an annuity basically are going to be income, guaranteed income at some point now or in the future. Obviously, like any sort of annuity construct, Social Security. The longer you defer taking that income, the higher it will be. The older you are, the higher it will be, right? Because the income amount's based off of life expectancy. But the
Mhm.
first reason why people purchase annuities are to provide guaranteed income at some point now or in the future. The second reason is for tax deferred growth of the capital. inside the annuity shell. And there's products, so in that space, there's products that have zero fees, zero riders. They're built purely just to kind of grow that capital and house it in a way that's designed to beat bonds by a percent or two over the duration. And there's no income rider in those. You could annuitize it and turn that into income at some point in the future, but it's not built for that specifically. So
So what would you do with that one then?
In that instance, you could annuitize it. You'd call the carrier, hey, how much, at the end of that contract, like how much would this, provide me if I annuitized it? But in those instances, typically you transfer it or 1035 it into an annuity that's built for guaranteed income if you one day did decide you wanted to.
Okay, so that one's not like a for life thing. That would be like a period, like a time period, like for 20 years. So that's kind of like a CD in that sense, but it's still called an
Yeah,
annuity.
so I'll kind of touch on those. So basically, the first version of that is what's called a MYGA, or a multi-year guaranteed annuity, and it's the insurance marketplace's equivalent of a CD. It's a guaranteed rate for a guaranteed duration, and that duration is whatever you choose, typically 3 to 10 years. Obviously the guaranteed rate on a 3-year MYGA in a normal yield curve environment is typically less than a 10-year MYGA. The longer you're illiquid for, the higher you get paid for it. The only difference between it and a CD is that the taxation is deferred till the end of the contract.
I see. Okay. So that's not really what we were talking, like our entire conversation as of now, up to now, that really has nothing to do with it. That's not what we're talking about. That just falls under the umbrella of annuity products. And that one is just for, give me a safe, constant return. I'm not going to pay taxes till the end. Okay, cool. So that's MYGA. Not what people are probably thinking through when they're hearing this talk.
And typically not. So then there's a version of that too called a fixed index annuity, where the carrier just paying you a fixed rate. You can index it to a market index like the S&P 500, where if the market does negative or zero, you don't make anything, and then they'll credit you up to a certain ceiling called a cap. Typically, right now it's around 9.5%, 10%, depending on the carrier and state. And anything over that, you don't get over the cap, but you do get that safety of that 0% floor. So those are kind of your growth oriented products. So now that those are out of the way, kind of going back to what most people purchase annuities for, are for guaranteed income. Okay, now and when you say annuity, most people think of single premium immediate annuities, or SPIAs, which are, you have a pile of capital, you give that to the insurance carrier, and you start taking income within 1 year.
Kind of like we described the VA claim, just without having to come up with the capital, sort of like
exactly.
That. Pay me now, starting now.
Yeah, you purchase a guaranteed income stream. There's typically no liquidity, and there are some features you can build onto that, right? There's the most basic form is a life only, where you're shouldering the risk of a premature death. Basically, you give away the capital, they pay you a large income stream, but if you die early, all that money's gone. Now you can tax safety features onto it, right? As you tax safety features onto it and you adjust that safety lever up, that income lever kind of starts coming down a little bit too. But most people will tack on what's called a 10-year period certain, where even if you purchase that annuity and you get struck by lightning the next day, well, those payments will go to a beneficiary for 10 years guaranteed. Yeah. You can also tack on what's called an installment refund, where in lieu of a 10-year period certain, if you pass away early, whatever hasn't been paid out from your initial premium will get paid to your beneficiary over typically around 5-year installment repayment period. Or you can just do what's called a cash refund, where the insurer will just cut a check for the remaining premium that hasn't been paid out to the beneficiary. Obviously, like I said, as you build those safety features onto the single premium immediate annuity, that income goes down. The less risk you shoulder, the less, and the more risk the insurer has to shoulder, they'll pay, they'll adjust that income stream commensurately.
Okay. Now, so single premium immediate annuity? I put up a chunk of money, I start getting paid monthly. Let's,
Yep.
you know, on the sliding scale of risk to value or risk to income, like you said, the more we remove some of that risk of dying early and not getting, our fulfillment of this effectively, the more we remove that risk, the lower the income goes. It's just going to be, you know, pretty basic. Like we can kind of understand that, like, going back to insurance terms, if you have a term policy, it costs X amount. If you add a rider that allows you to convert that policy to a whole life, it's going to be more. It's going to be X plus some amount, right? Because you're adding value to what you're getting. Therefore, the cost of it's going up. In the same way, you're adding value by decreasing the risk. Therefore, your income is going to go down. Just a very understandable risk to return ratio there. We're just moving a lever, like you said. You move the safety lever up, the income lever is going to go down, vice versa. But let's just take that single payment annuity, strip off all the riders. I pay you money today. You start paying me income for life based on my age, mortality, etc. How is that taxed?
So that is taxed. Basically, it's called it's taxed via an exclusion ratio, and it depends on the capital that goes into it. Right now, if you have an existing annuity that goes into it, where you have a basis amount, say it's a $200,000 premium purchase, and your basis is $100,000, and you also have $100,000 of gain in it. Well, it's taxed via what's called an exclusion ratio, where they blend the basis and the gain and account for your age and your life expectancy. And so it's a kind of a calculated number by the insurance carrier, where a portion of it is taxable and a portion is not.
Okay. I've read about in my textbooks for the CLU course, I've read pretty extensively on the taxation of annuities. It's like 4 full chapters just on that, and it is very confusing. So I don't want to get into, let's just sum it up. It's not taxed like ordinary income. It's not taxed like capital gains. It is taxed, and it is in kind of a convoluted, hard to understand way, because there's all these. I remember like reading about the IRS codes and basis, and so much of that tax code is, how do you value items? How do you determine the value of an item? And so there is a complicated calculation that companies will use that is in line with how the IRS views it. But just to sum it up, it is taxed, not in the way that we're used to with ordinary income.
Yeah. Well, and again, it's not a general rule too. It depends on, what pool of assets you are using to pay the premium. If you're using qualified assets that you haven't paid taxes on, 100% of that income stream will be taxable. But if it's,
as ordinary income,
yeah.
Okay.
If the pool of premium you use is all non-qualified, meaning you've paid taxes on it, well, a very small amount of that income stream will be taxable. If it's a blended amount where you have a lot of taxable gain and you have some basis, that's where these things really shine, because other annuity constructs that are paid on taxes are paid on a last in first out, so it's all taxable until you get down to your basis. They blend the exclusion, they use that exclusion ratio calculator, blend the basis with the gain, and you get to space that taxation of your gain out over a much longer period of time.
Okay.
So it's very confusing. Yeah.
Let's put a plug in the tax.
Yeah. It comes down to an individual case by case basis. What are you planning on using to fund the annuity? And, so there's no like general rule, but, you could use pre-tax dollars. You can use post-tax dollars. You could use an existing annuity that has, again, a portion of of taxable dollars and a portion of non-qualified dollars that you use to fund it. But it's a specific case by case scenario, and we could chat about the taxation of that with you
Okay.
if you want. Yeah.
I've read it and taken tests on this, and I'm confused. So if you're listening and you're not ever thinking about annuities, I don't want to get any more into the taxation weeds. There is some taxes on it. If you have this conversation and you book a call with Travis, talk through the tax situation of what you're trying to do there. But all right. Forget I asked about taxes.
Now that everyone's confused,
Yeah.
stop listening. No, just kidding. But all right, so kind of moving on to a single premium immediate annuity, or SPIA. That is when you want income within 13 months. Okay. Now, the same exact construct where you're deferring income past 13 months is called a DIA, or deferred income annuity. It's everything the same. You could tack on those safety features like we talked about, a fully guaranteed, a period certain, or a cash refund, or an installment refund. It works functionally the same, except you're not turning that income on until after 13 months from the time of purchase. Okay.
So when that kind of made up example I said, where you're 37 now, but I'm going to start paying you at age 50 at the beginning, that would be that would be a deferred annuity, in that you're not going to take income right away. You're going to wait and let that money grow and marinate until you start pulling from it.
Right.
Okay.
Right. Now on
cool.
again, we talked about kind of the growth chassis on the income chassis. Right now, relatively newer products that have rolled out within the last 15, 18 years or so, fixed index annuities with a guaranteed income rider. So basically, you can use qualified funds, you can use non-qualified funds, you can use an existing annuity and roll it into this. But this is a chassis that's built to provide guaranteed income too, except versus the kind of older model SPIA DIA counterpart, you do have control and access to some of that liquidity and your principal that is housed in the annuity shell. Okay. So basically, you use a pool of assets to purchase the annuity. That asset pool is indexed to a market index like the S&P 500. And next to your account value, you also have this electable guaranteed income stream that you could turn on at any time. And right now, just with the way rates are, and these being kind of newer products, more modern products, the fully guaranteed income amounts from these are on average typically higher than their single premium immediate annuity or deferred income annuity counterparts.
Okay. There's a lot here, and this is
sorry.
where. No, this is good, because this is where you should go and talk to Travis if you want to explore these different ways that you could approach this. And so we've got, when are you taking the money? How are you contributing the money? Like how does the money go in? How does the money come out? When does it come out? And the other kind of general broad categories of decisions.
Yeah, I would say, for me, when I talk to clients, you tell me what you want the capital to do. Typically it's to provide a fully guaranteed income stream. Okay, well, at what point do you want that to start? So I plug that into my, software, my scenario. I plug your age, the deferral amount, the premium amount, your state, and the age at which you want to start that income stream. And I go out, I look under every rock in the marketplace and find the product that's going to provide the most amount of fully guaranteed income at that desired income start age. All of this stuff we're talking about, the fixed index annuity with a guaranteed lifetime income rider, your SPIA, DIA, it's super confusing. And I know when clients try and navigate it themselves, I see the byproduct of that oftentimes when they bring me an existing statement and it's like, should I turn income on here or not? And it's like, guys, you bought this in a low interest rate environment. It's from a crummy company. If we can transfer it, we can increase your fully guaranteed income amount by 40% with no extra, out of pocket expenses. And people are like, oh, how do I do that? So don't, if you try and navigate it yourself, 9 times out of 10 folks end up in kind of subpar, annuity products. They don't understand it. I want you to, you should understand it. It should be easy to understand. And there's a lot of complex stuff being thrown around out there that, inevitably ends up with a client kind of confused and frustrated, and a product that does stuff that's kind of out of alignment with their objective.
Yeah, and so there's a lot of decisions that could be made. There's a lot of flavors of this. There's a lot of things that are going to be overwhelming if you're just like, okay, I want an annuity. How do I pick one, right? So having someone to navigate that with, you're gonna off the bat eliminate, like what someone could go in and just start researching on Google. What are different annuities? You can trim off probably 70% of the options just based on a quick conversation, based on your age, based on what you're looking for. On the goals here, like, you don't need to even really worry about these decisions. We need to figure out, when do you want the income? How much do you want to put in? Do you want to put it in all at once? Do you want to space it out? When do you want to pull these levers? Like, that's where you can have this guided conversation. And so let's take two different people. The really powerful one is that we talked about is someone has an existing annuity. Now, I don't know too many folks our age that have annuities, but we've got some clients in their 50s and 60s willing to bet that some of them have annuities. Someone goes to your calendar and says, I have an annuity. Can we improve this? What does that conversation look like?
Yeah, basically, all I need is the most recent statement, the client's date of birth, their state of residency, and what their general objective is. Like, in a lot of cases, they don't really know. They bought this annuity because it had an income rider. And in a lot of cases, we see these older products, they're really fee heavy. And the income, just because they were bought in a much lower interest rate environment, is just not competitive to what they could have currently in the marketplace. And I think a good analogy is, kind of the mortgage rate analogy.
Yeah, that's
a lot of folks have older mortgages with with higher rates. I know my parents bought a house in the, early 90s, and the going rate was like 9 or 10%. And it didn't mean that was bad at the time. It was just what it was. Well, as rates kind of fell into the ultra low interest rate environment, it's good to, take a look at that stuff, see if you could, kind of get better terms. And it's the same thing in the annuity world, just kind of the inverse. A lot of folks bought these annuities in a very low rate environment, and because of that, they have low payouts, and some of them, some of these older annuities have higher fees, and clients just don't understand what they have, and nobody's dusted it off or looked at it or given it a professional review or audit in a long time. And simply doing that, which takes me, a couple hours to kind of scour the marketplace and read through some of the fine print, we could really uncover the ability to transfer it to a new carrier, and a new product that's pegged to much higher interest rates, and increase the amount of fully guaranteed income for people.
So there's someone listening who has an annuity who could, without spending any out-of-pocket money, turn their existing income stream and lever that up or increase it to reflect market rates. Kind of like you have a 30-year fixed-rate mortgage, your rate's not going to change unless you decide to change it. And you would only decide to change it if rates go down enough that you refinance it, that the numbers are worth it. So like if you refinance your mortgage, you're going to start that compound curve again, or the interest curve, right? You're going to start that 30-year timer over. So there's some cost there. That's why you wouldn't just do it for maybe a 0.5% drop in the rate. But there is a point where it makes sense that, yes, I'm going to incur some cost by doing this, but I'm going to get a better monthly, like the numbers make sense at a certain point for someone to refinance their mortgage to a lower rate. In the same way, however all of the costs work of acquiring this new annuity, rolling it into it, and that's your job, that's your wheelhouse. People can come to you with an existing annuity with a lower rate without spending any out-of-pocket money, turn that into a higher performing income stream. Is that right?
Yeah, and for a person who bought an annuity for guaranteed income, if you look at your statement and it's like trying to read Mandarin and you're confused about what you
Mm-hmm.
have, like there's no obligation. Like I will tell you exactly what you have, what it is, and if there's improvement opportunity, great. I'll let you know. But I've no, there's no problem, and I see products that come across my desk all the time where, at least in those cases, the client kind of gets a pat on the back, like, "Hey, you are in a good spot here. Like, there's nothing that needs
Yeah.
to be done." But people typically never know, and one of the problems in the industry is, they get sold these products by their financial advisor or their golf buddy they met on the golf course who's an annuity guy, and they make the commission, they move on, and no one ever reviews them. And it's kind of
Yeah.
funny. Here's $200,000-300,000 sitting in this old annuity that no one's ever looked at, yet the client checks their brokerage account 10 times a day. And
Yeah.
here we can improve guaranteed income by, I just did one earlier yesterday. The client had a product that offered like $21,000 of fully guaranteed income if they elected to turn the rider on, and we transferred it, and they're at like 28 and a half. You know,
Yeah.
that's another $7,500 of value that they're going to get
It's
on
just
a
sitting there
year in year
untouched,
out basis,
just left
just
on the
sitting
table.
out there untapped, just because nobody had taken the time or really realized that, like, these things need to be audited at least once a year, and it's the annuity companies never want to, they'll never reach out to audit. They love when people don't review their annuities, because
Yeah.
they're getting to keep that asset pool in their float and make arbitrage in a higher interest rate environment. And the product was sold in a low interest rate environment, so the contractual guarantees are super low, and so they don't, it's not tough to meet those contractual guarantees while they're making, their 4.5-5% on your assets.
Yeah. That, that kind of reminded me. This is just a point I want to make. That's not like specific to that, but one example of the difference in thinking between someone who's a bond investor and just a bond owner who's using it for income. If you think about an insurance company, right? They have a deep pool, like some of the most well capitalized companies in the world, right? And so they have these ladders of bonds that we could never access. Like if the market goes down right now and I'm looking at a single bond that I own or a bond index fund or looking at my stocks going down, I don't have that many options here. Like I'm going to lose money, right? If it's 2022 and bonds and stocks go down in sync, I'm just going to lose, like my unrealized losses are going to grow, right? If you're an insurance company, you don't really care necessarily that the bond market, like that the rates are going down or going up, if you're basing your projections and your conservative capital growth. If you have a 7% bond from 20 years ago, 30 years ago, whatever it is, you can bank on that and you have certainty that this bond is going to pay 7% a year. So maybe the market rates on bonds are 9% right now, maybe they're 2%. You don't necessarily have to care if you're running your numbers and your calculations and you're saying we're going to be guaranteeing paying out these death benefits, et cetera. We know that this bond will pay 7% a year for the duration of the bond. That's certainty. That's a fixed way to look at a bond. If you're a bond trader, you don't think that way, right? If you're a bond trader and you have a 7% bond and rates go up to 9%, well, now you're like, well, I'm underwater on this bond. Well, you're not. You're still making 7%. It's just if you're in the business of cycling these through and trying to follow and maintain the highest rate, that's a different way of thinking. That's not bad. That's like a knock on bond trading, but it's just a different mentality switch. And so if we think like in terms of annuity, in terms of certainty, part of our assets, part of our portfolio, we are chasing that high return. We want to get the highest quantity of money. But then we're looking over here, well, I don't really care what the rest of the market's doing because I want the certainty of this guaranteed income stream. I want the certainty of this 7% bond, and I can make plans based off if I know I'm getting $3,000 a month, I can make plans on how I'm going to budget. I don't have to worry about what the market's doing. It's just, it kind of came to me like I've made that point before about the distinction in how you might approach a bond. And so not really necessarily part of what we were just discussing, but something that like, it's just a different way of thinking about the two main pillars of your financial strategy. quantity assets, quality assets. And again, we're living in the quality asset world right here. But it is good to know if you do have, like, if you have the ability to lock in that rate, right? If you don't touch it, it's just not going to change. You're going to get that guaranteed income. But you do have the option to trade that out for a better performing product and lock in today's rates in the same way that you could choose to refinance your mortgage.
Yeah, and
It's
just
nice
put
that you
yourself
can
in a better
decide.
position that's tied to a higher rate and higher payout environment. And
Yeah.
it's just not a super intrinsic thing. Of course, like I said, the carriers they want you to be, they want that money to sit there untouched and no one ever review, and not have anybody ever review it, because they love when payouts, that this block of business is attached to a payout rate that was at, ultra sold in an ultra low interest rate environment,
Right.
um, so yeah, that is
Because
kind of
they're
where I
looking at that
see.
from the arbitrage,
Yeah, and that's
and
where I
you're not.
see a majority of the action right now is just folks who have older products that that have been sitting on the books for a long time that nobody's ever looked at, and we're able to kind of take a peek under the hood, provide a really professional audit, and then give that person options. In some cases, they're really beneficial options, via transferring to a updated, kind of more modern strategy. But in some cases they're not, and that's fine. And I think the important part is that folks know exactly what they have, and that there's no confusion, and that they're in control of their portfolio.
So, okay, so we're at an hour now. That's probably 59 minutes more than most people ever think about annuities. Because the last time you ever thought about it was you saw a Fisher commercial saying they're all ripoffs and pay us a fee to get you out of your annuity or something. So I hope that's not how you think about annuities. But if if you're listening and you want to have that conversation, I think it's very worthwhile. But let's just say I don't have an annuity. I'm 37. I'm going to assume the average listener is me exactly, but we're going to go with doppelganger me that never
Okay.
got, you know, never got out of the military because of the mandate stuff, right? So I'm 37. I got, I'm an 04 in the military. I'm still in. I've got a couple more years until I hit 20, so that's a pension that I'm working to do that pension, right? If you're still in the military, hanging on till that 20-year mark, you're doing that because you understand the value of a guaranteed income stream for life, right? So you do have some notion of annuities if you're trying to get that pension, if you're trying to get that VA disability claim. So let's just say I'm 37, making good income right now. Uh, I come to you and I schedule a call. Is is there a point for me to get an annuity right now, or is it kind of like long term care where you say, hey, maybe in the mid 50s we think about it? Like what would be the pitch
Yeah,
to someone like me, or is there
I,
one?
I just think there's too much runway ahead of you before you're ever gonna be turn on that guaranteed income stream. We don't know what's going to happen. It would be very unusual for someone your age, to come in
Okay.
and be interested in an annuity. And you're not you. Yeah, that I honestly I don't think I've talked to a client younger than 43, 44 about annuities.
Okay.
Yeah.
So there's not, because someone might be thinking, okay, well, I've got 100 grand and I was trying to figure out what to do with it. If I give them, if I buy an annuity now and I defer it for 25 years, like, is that enough time for it to marinate? Or there's risk there that, like, if I'm not even going to start taking income for that long, it's not worth the risk of me dying and not getting there, kind of thing. Like, it's just not
I
a
just think,
scenario
like I
where,
said, the runway's so long, and that's where kind of the managed money. Hey, like, grow this money. Let it sit there and take the ups and downs of the market and get that 7.5, 8% return. Probably makes more
right.
sense than putting it into an illiquid annuity contract, just because you
Okay.
have that ability to take losses and recover, and hopefully the marketplace continues to return that historical average of 7-8% over the next couple decades there.
So, and I think that that's kind of analogous to the, say, the 60/40 portfolio. The Even though I think that model's dead. If you understand whole life insurance and you use it the way we do for IPC, mutual company, been paying a dividend over 100 years, et cetera. When I look at my policies, I fully replace the role of bonds with my policies for when I get into those later years. And there's some people like Dr. Tom Wall and Dr. Wade Fowle who do a lot of research on this. The role of bonds in your portfolio, I think, is better suited for a whole life insurance contract or an annuity, depending on how, like depending on the timing of it. But inherently, the fact that they pitch a 60/40 portfolio when you're in retirement, they intuitively understand that there is a need to shift away from growth and risk assets into safety, right? Because of the time frame. We don't have time to recover from losses, right? So they intuitively understand the value of quality assets. I just don't think when you're talking 60/40 portfolio and it just in conventional portfolio theory, I don't think that safety quality asset should be bonds, because we've seen in the last couple of years they don't always move as like a counterweight to each other, in spite of the over kind of the portfolio theory behind it. But so this, I think, is a good quality asset for the right person at the right age at the right time, having those conversations. But more importantly, I think if even one person listening gets on your calendar and improves the cash flow from their existing annuity, that's a win right there. And our goal, besides setting up life insurance policies, is we really focus on the education piece. The same way you said you should understand the annuity you have, and most people don't. That's the same way people have with life insurance. That's the same people with their 401ks. They don't actually understand it. They don't know that private credit has basically held their 401k with a knife to the throat, and that to like all the risk inherent in it. They don't know who's actually managing it. There's all these things that we don't know. And I tell every client, I want this whole life policy to be the asset that you understand the most. If I die tomorrow, if I'm not here, I want you to know exactly why you got these riders, why we needed this length or this amount of term rider for like the Mechlin, all these conversations that we have. I want you to really understand this asset, not just take my word for it and get it. Like, I want you to understand this. In the same way, if you have an annuity, you should understand it. If you have one and you don't feel like you understand it, if you couldn't have said everything Travis just said yourself, it behooves you to go and have that conversation and make sure you're getting that professional audit. Anything else we're missing on the annuity conversation there?
No, I would say, whether you talk to me and I'm a broker, I have access to every major carrier in the marketplace. But whether you talk to me or whether you talk to another broker, make sure that you understand what you're getting into. Understand their and if you're talking to someone who's trying to talk you out of annuities, understand the incentive structure behind that, and if you do purchase an annuity, purchase it for the contractual guarantees. There's a lot of stuff flying out there, and again, one of the flying around out there. One of the reasons why some folks are hesitant about annuities. There's a lot of like non-contractually guaranteed elements in some of these annuities that are marketed and sold as though like, hey, your annuity is gonna do this, when the contractual guarantee offers this. And so I think purchase annuities for the contractual guarantees. Don't purchase it for the the non-guaranteed illustrated sort of return that a lot of this stuff is a lot of that sort of stuff is pushed on people, and just be careful. Yep. And if you have any questions, reach out to Hans, reach out to myself. I'm happy to talk you through it. And like I said, I think we hit the nail on the head, and maybe beating a dead horse here, but a lot of these older annuities just are not competitive, and folks are missing out because there's a huge opportunity to improve them right now.
Yep. We're in the business of beating dead horses around here.
Okay.
But and talking about it sounded we could have substituted out like a whole life versus IUL conversation. Flashy marketing, high risk product with the IUL. It looks great on paper, does not perform historically, and I think will mostly will go the way of UL down the road, where it's effectively phased out and not sold because of actual performance rates. However, I think the life insurance industry deserves a black eye that it has. It hasn't represented itself well. There's a lot of poorly written products, and it doesn't really understand the power of what it actually has, and it's tried to keep up with the marketing and the desire for more for high quantity in coming up with products like IULs, et cetera. But I don't think it understands and fully, or if they understand it, they don't do a good job representing the value that the whole life contract has. In the same way, I'm not an expert in the annuity space. I'm sure that a lot of the black eye that the industry has is self-imposed, and if that's the case, give it the due diligence and actually consider, does it make sense for you? So thanks for coming on again, Travis. I really appreciate that. And hopefully someone out there decides to take a look at what they have and see if they can improve.
All right. Well, sounds good. Thanks for having me. Always great to be on the podcast, and I will chat soon.
All right. Thanks, man. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.